Hi, in today's class, we are going to be dissecting the concept of weighted average cost of capital of the combined activities, which I called WACCOCA. So far, so good. Under cost of capital, we have discussed the concept of traditional weighted average cost of capital. We have dissected project-specific cost of capital. So the last scope under cost of capital will then be WACCOCA. Therefore, what do you understand by WACCOCA? Weighted average cost of capital of the combined activities is computed when a company is engaged in two or more investment activities in different industries. Okay, when a company is engaged in two or more investment activities in different industries, that is when you compute the WACCOCA. For example, a company may be engaged in oil and gas. The company may also be engaged in communication business or real estate business. So instead of having different cost of capital to appraise project in each of the industry, a singular cost of capital will be computed that will be suitable to appraise all the projects in different industry. Therefore, when computing the weighted average cost of capital of the combined activities, 7 procedures must be considered. There are 7 different steps that can be used to compute the projects, to compute weighted average cost of capital of the combined activity for the purpose of appraising a project. So, yes, let me show you the 7 procedures that can be used to compute project specific. Okay, sorry, to compute the WACCOCA. Now, step 1. Okay, let's start from here. Steps involved in calculating WACCOCA. Okay, like I said, there are 7 different procedures. 5 of the procedure you normally do under project-specific cost of capital plus additional 2. So the first step, when calculating project-specific cost of, when calculating WACCOCA, the first step is to identify the beta of each activity. Okay, identify the beta of each activity. Okay, that's the first step. It may well be that you have real estate, communication, oil and gas, or education business, whatever the activity or of the project. So just identify the beta of each of them. Then step 2, ungear the beta. Ungear the beta if geared. Okay, you already know how to ungear. The same formula you are going to use to ungear as we did under project specific cost of capital, or let me just put it there. I will use only one of the 2 formulas. So to ungear, so we calculate beta assets. Beta asset will be computed as the beta equity of a gear multiplied by equity value over equity plus debt value 1 minus tax. Okay, that's the formula. But if that you are given a debt beta, if you are given a debt beta, then you use the extended formula, which is the debt beta multiplied by debt value multiplied by 1 minus tax divided by equity value plus debt value, okay, 1 minus tax. So that's the formula. So you use this formula only when debt beta is given. When this guy is given, that's when you use the extended formula. You already know. But where debt beta is risk-free, then the beta assets can be calculated as beta equity of a gear multiplied by equity value divided by equity plus debt 1 minus tax. Okay, so that's the formula you are supposed to use. This is where This formula is used where debt beta is risk-free, where debt beta is equal to 0. Okay, that is risk-free. Risk-free, that is equal to 0. Okay, so but where you are given debt beta, then you use the first one. Then step 3, you calculate market value of equity and debts. Step 3, calculate market value of equity and debts of each activity. Okay, of each activity. You already know how to calculate market value of equity and debt, so no need for me to give you that. Or let me just put it there. So market value of equity will be computed as number of shares multiplied by share price. That will give you the market value of equity. So the market value of the debt will then be calculated as nominal value. Okay, nominal value multiplied by interest expense divided by 100 naira. Debt is quoted at 100 naira per unit. So whatever you have here, and this one too, you add the two of them together, that will give you total market value of equity and debt. That will be total market value of equity and debt. All right, so that's that. Then step 4. Step 4, you are supposed to, in step 4, you calculate. In step 4, you calculate beta asset of the combined. Okay, calculate beta assets of the combined. Let me write it out in full. Beta assets of the combined, or weighted average asset beta. Beta asset of the combined, or weighted average beta. Weighted average asset beta. Asset beta. Okay, so the beta asset of the combined will be computed as, okay, the beta assets of the first activity. So we're assuming that there are two different activities in this formula. So there are two different activities. So you pick the beta asset of the first activity, multiply with the total market value of equity and debt of the first activity, divided by total market value of equity and debt of the first and second activity. Okay, plus, open a bracket, the beta assets of the second activity multiplied by total market value of equity and debt of the second activity divided by total market value of equity and debt of the first and second activity. So that is the formula to calculate the weighted average asset beta. Then step 5. Okay, step 5, you regear. Okay, you regear to incorporate financial risk. Let me move to the next page. Step 5, you regear to incorporate financial risk of the company. So once you get from step 1 to step 4, you are going to be using the information of each of the activities or each of the projects. But as you are moving to step 5, you are going to be using the information of the company. Therefore, so to regear, I would then say beta equity of a gear, depending on whether debt is risk-free or debt is given, debt beta is given. So beta equity of a gear will be computed as beta assets of the combined, okay, multiplied by 1 plus 1 minus tax. Then debt equity proportion of the company. In this case, this will be the debt equity proportion of the company. So this formula will be used where debt beta is risk-free. So this is used where debt beta is risk-free. Let me put it down. Where debt beta is risk-free. That is equal to 0. So that is when you use this formula. However, if in the question you are given debt beta, then you are going to use the extended formula. Just repeat the extended formula. In this case, the beta asset of the combined will then be calculated as the beta equity of a gear, which you are looking for, okay, multiplied by equity value of the company over equity plus the debt, 1 minus tax of the company, not of the activity, plus the debt beta given, okay, multiplied by debt value, 1 minus tax, over equity value plus debt value 1 minus tax of the company. Okay, so this formula will be used where debt beta is given. Okay, so where debt beta is given, that's the formula you are expected to use. Okay, then number 6, step 6. So you calculate cost of equity. Calculate cost of equity. Okay, using capping, KE, using capitalized pricing model. How do you do this? You already know the formula. So cost of equity will be computed as risk-free rate of return plus the beta, okay, beta equity of a gear multiplied by market return minus the risk-free rate of return. Then finally, step 7. So you calculate WACCOCA, work of the combined activity, denoted as KW. So the work of the combined activity is computed as KW, which is work, over multiplied by equity value over equity plus debt, cost of equity computed in step 6, then plus debt value over equity plus debt multiplied by cost of debt, okay, multiplied by 1 minus tax rate. In a situation whereby cost of borrowing is not given, you are expected to use the risk-free rate of return to replace the cost of debt. Okay, so these are the 7 different procedures you are expected to carry out whenever you want to calculate WACCOCA. Step 1 is to compute, okay, is to identify the beta of each of the activity in each industry. Then step 2, you ungear the beta if it is geared. But if the beta is not geared, then you are going to ignore step 2. Okay, so the formula to ungear, you have it there. I've already explained there. Then step 3, you calculate the market value of equity and debt of each of the activities. Also, I've shown you how to calculate the market value of equity and debt. Then step 4, you calculate the beta asset of the combined or combined asset beta. Okay, the combined asset beta, I've also shown you how to calculate it given the formula. Then step 5, you regear. Step 6, you cap it. Step 7, you work it. That's all. Those are the procedures you are expected to carry out whenever you want to compute project-specific, WACCOCA. So at this point, let's have illustration. Okay, Columbia PLC provides training and financial services. The training service accounts for 2/3 of the value of the company. The company has a total debt to total market value ratio of 30%. Okay, so this company is into 2 different activities, training and financial services. So training industry is different from financial service industry. So there are two different activities. Okay, so move on. Paragraph 2. The average beta and debt to total market value of financial service sector are 0.9 and then 25%. So average beta of financial service is 0.9. Then debt to total market value is 25%. Okay, so if debt is 25%, equity will be 75 for financial service. Next one, the average beta and debt to total market value of training service sector are 1.5 and then 12%. So the beta of training is 1.5. So the debt equity ratio is 12%. So if debt is 12%, equity will be 88%. Other information includes the equity risk premium is 3.5. Risk premium is the difference between the market return and the risk-free rate of return. And the rate of return on short-dated government stock is 4.5%. Rate of return on short-dated government stock is 4.5%. That is the risk-free rate of return. So the risk-free rate of return is 4.5. Number 2, Columbia PLC can borrow at 2.5% above the risk-free rate of return. So the cost of borrowing, okay, the cost of borrowing, the coupon rate is 2.5% above risk-free rate of return of 4%, which means that the KD, cost of debt, will be equal to 4.5, okay, will be 2.5% plus 4.5%, which is equal to 7%, because we are told that the company can borrow at 2.5 above risk-free rate of return. The risk-free rate of return is 4.5. 2.5 above 4.5 will be 2.5 plus 4.5, which is 7%. So KD is 7%. Corporation tax is 40% on taxable profit. Assume that debt beta is risk-free. Okay, so meaning that the BD is equal to 0. So there's no need for us to use the extended formula. Therefore, you are required to estimate the cost of equity capital, which is capping, and then weighted average cost of capital for Colombia. So in this case, since Colombia is engaged in training and financial services, that means we are going to the appropriate cost of capital that will be suitable to appraise both training and financial service will be the WACCOCA. Therefore, let's calculate WACCOCA. The first step says, okay, let's push it down. Solution. The name of the company is Columbia PLC. Step 1, we will identify the beta of each activity. So there's no need for you to say identify the beta, just say beta of each, or beta of training and financial services. Okay, let's identify the beta. So training, denoted as T, will be equal to, then financial will be denoted as F. So let's go back to the question and identify the beta of training. So according to the question, we are told that the average beta, okay, the average beta and debt to total market value for training service sector are 1.5. So beta of training service is 1.5, then the beta of financial service is 0.9. Okay, training is 1.5, financial service is 0.9. With this, I've identified the beta of each activity. Step 2 says that we should calculate, or we should ungear the beta if it is geared. Before I put down my formula, I need to go back to the question. If I have debt, if each of the activity has debt, okay, but again, there is debt because we are told that debt to total market value of financial service is 25%. debt to total market value of training service is 12%. So there is debt. In that case, we need to ungear. So I would then say ungear. So to ungear, which formula am I going to use? Examiner has told us that debt beta is assumed to be risk-free. Okay, debt beta is assumed to be risk-free. Therefore, I would then say for first thing first, I need to put down my formula. So beta assets will be computed as, if I like, I can say beta equity of a gear multiplied by equity value divided by equity value plus debt value 1 minus tax. Okay, so that will be the formula, or I can say I can also use another formula to compute to get the same thing. All right, or I can say beta assets equal to the beta equity of a gear multiplied by 1 divided by 1 plus 1 minus tax. Then debt equity proportion of each of the activity. Okay, so whichever one I use, I will get the same answer. Let's see. So equal the beta equity of a gear. I will go back to the question. So for training service, okay, for T, I want to calculate the beta asset of training. Let me use it. So for training service will be equal to beta equity of a gear of training. According to the question, for training, this is where we have training. So the debt to total market value of training service sector is 12%. So debt equity ratio of training service is 12%. So if debt is 12%, equity will be 88%. Therefore, so that beta, that's the beta we have in step 1 for training is 1.5. So here will be 1.5 multiplied by equity value of training is 88 because debt is 12%, then equity will be 88%. So divided by 88 plus 12, which is debt, equity plus debt, multiplied by what's the tax rates? The company tax rates we are told is 40%. Yes, the corporation tax is 40%. Okay, corporation tax is 40%. All right. So 1 minus 40% will give us 60%. That's it. So for training, then we are going to have 0.6 multiplied by 12 plus, okay, plus 88 equal, then 88 divided by answer, 88 divided by 88.612, okay, equal, multiply by 1.5 equal, that's 1.49. Here is 1.49. Okay, 1.49. Let's confirm again. Let's confirm again. 0.6 multiplied by 12. That's 7.2. 7.2 plus 88. Oh, 95.2. So 95. So 88 divided by 95.2 equal. Then multiply by 1.5 equal. That's 1.39. Here is 1.39. So if I don't want to use this formula, I can also use this formula. I will get the same answer for training. I will get the same answer. For example, I can say for training, all right, Okay, so alternatively, I can say T equal to, using the other formula, then the beta equity of a gear is 1.5, then multiply by 1 divided by 1 plus 1 minus tax is 0.60, multiply by debt equity proportion of training. So for training, debt is 12%, equity is 88%. So I should have the same answer. So this then will be equal to 12 divided by 88 equal, multiply by 0.6 equal, plus 1 equal. Okay, so 1 divided by answer. Okay, 1 divided by 1.082. 1 divided by 1.082 equal. Then multiply by 1.5 equal. That's 1.39. So we'll get the same answer as 1.39. So whether I use this formula, okay, this is for this, okay, then the second formula is for this. So whichever one I use, I should get the same answer. So I'm done with T. Then I'll go to F. I'll go to F. So for F, beta equity of a gear of F is 0.9. Beta equity of a gear of F is 0.9 multiplied by equity value of financial service. We are told that debt equity proportion of financial service is 25%. So if debt is 25%, equity will be 75%. So this should be 75 over 75 plus debt of 25. 1 minus tax is 0.6. Okay. Therefore, this will then be equal to, yeah, 0.6 multiplied by 25 equal, plus 75 equal, then 75 divided by 90 equal, multiplied by 0.9. Okay, is it 0.9? Yeah, multiplied by 0.9. 0.9 equal, that's 0.75. Let me do it again. 75 divided by 90. Okay, 75 divided by 90 equal. Then multiply by 0.9 equal. That's 0.75. There is 0.75. So the beta asset of financial service is 0.75. So that is step 2. I will then move to step 3. Step 3 says I should calculating market value of equity and debts of each activity. So examiner has told us, according to the question, that the total market value of, we are told in the first paragraph that the training service account for 2/3 of the total, the 2/3 of the value of the company. So training service account for 2/3. It means that financial service will account for 1/3 of the market value. Okay. So training is equal to 2/3, 2/3, while financial service is 1/3 of the company's total market value. So step 4, examiner has made life easy in this step 3. So there's no need for you to go and be calculating it. It's already given to you. So step 4, calculate. We are going to calculate the combined or the weighted average asset beta. Okay, so you call it combined asset beta. Okay, so the combined asset beta or beta assets of the combined will be computed as the beta asset of training service multiplied by the total market value of the training service divided by total market value of training and financial service on one side plus the beta asset of financial service multiplied by total market value of financial divided by total market value of training and then financial. Okay, then beta assets will then be equal to the beta asset of training. The beta asset of training, the on-gear beta we calculated for training is 1.39. Here is 1.39 multiplied by total market value of training is 2/3. Okay, here is 2/3 plus, open a bracket, the beta assets of financial service is 0.75. 0.75 multiplied by the total market value of financial service is 1/3. So mathematically, the beta assets, okay? So the beta assets of the combined will then be equal to, this will be, okay? So this will be 1.2/3, 2 divided by 3 multiplied by 1.39 equal, okay, that's 0.93. Sorry, this is 0.93 plus then 0.75 divided by 3, that's 0.25. Here is 0.25. Therefore, the beta asset of the combined will then be equal to plus what do we have there? 0.93 plus 0.93 equal, that's 1.18. 1.18 is the beta of the combined. That's the beta asset of the combined. Okay. Now that we have the beta asset of the combined, so the next thing we need to do is to move to step 4, which is step 5, which is to regear. Step 5 says we should regear. You regear in order to incorporate financial risk of the company of Colombia. Therefore, the beta equity of a gear, since that beta is assumed to be risk-free, then will be computed as the beta asset of the combined, okay, multiplied by 1 plus 1 minus tax, multiplied by debt equity proportion of Colombia. Okay. So beta equity of a gear equal to 1.18. The combined asset beta is 1.18 we got. Okay. So 1.18 multiplied by 1 plus 1 minus tax, 1 minus 0.4 will give us 0.60. So 0.60 multiplied by debt equity proportion of the company. We are told in the first paragraph of the question that the training service, the company has a total debt to total market value ratio of 30%. Debt is 30%, equity will be 90%. So debt is 30%, equity is 70%. Debt is equal to 0.3. Then equity will be equal to, let me just put 30. Then equity will be 70. So we don't need to waste time on this. Okay. So debt is 30. Equity is 70. That's it. Therefore, the beta equity of a gear will then be equal to 30 divided by 70. 30 divided by 70 multiplied by 0.6 plus 1 equal, then multiply by 1.18 equal 1.48. Here is 1.48. So the beta equity of a gear is 1.18. Then step 6, we need to calculate cost of equity using capping. Calculate capping. Okay. So capping is calculated as risk-free rate of return plus the beta equity of a gear multiplied by market return minus the risk-free rate of return. Therefore, cost of equity, according to the question, we are told that risk-free rate of return is 4.5%. So risk-free rate of return is 4.5%. Okay. The market return, we are told that we are not given market return, but we are given risk premium of 3.5%. Risk premium is the difference between the market return and the risk-free rate of return, which is 3.5. Therefore, so here it will be 4.5 plus beta equity of a gear 1.48 multiplied by risk premium of 3.5. Okay, therefore cost of equity will then be equal to 3.5 multiplied by 1.48 plus 4.5 equal 9.68. Here is 9.68%. So finally, we need to calculate the WACC. We need to calculate the WACC. Okay. That's step 7. Okay, step 4, step 5, then step 6. So step 7 now, which is the last step. Calculate WACCOCA. Denoted as KW. So KW equal to equity value over equity plus debt multiplied by cost of equity plus debt value, equity plus debt multiplied by cost of debt, 1 minus tax. That's it. It's as simple as that. Therefore, WACC will be equal to equity value. We are told that debt is 30%, equity is 70%. Therefore, that will be 17 over 100. So I don't need to say 17 over 100, just say 0.7 multiplied by, multiplied by cost of equity. Cost of equity, we got 9.68 multiplied by 9.68. Okay, plus the other side, debt is 30%. That is 30 over 100 will give us 0.3. Then multiply by after tax cost of debt. I will then go to the question, what is the cost of debt? According to the question, KD, we are told that Columbia PLC can borrow at 2.5% above the risk-free rate of return. So the risk-free rate of return is 4.5%. 2.5% above 4%, that's 7%. I've done the working before. So KD is 7%. Okay. So here is 7. Then multiply by after tax cost of debt, 1 minus tax. Tax rate is 40%, so we are counting for 60%, 0.60. So give it to me. KW equal. So 9.68 multiplied by 0.7 equal. That's 6.78. Here is 6.78% plus the other side. So the other side is 0.3 multiplied by 7 multiplied by 0.6 equal 1.26. Therefore, WACCOCA is equal to 1.26 plus 6.78 equal 8.04. So here is 8.04%. That's it. That's it. That's the end of the question. Okay. So this is how to calculate weighted average cost of capital of the combined activity. 7 procedures. The first procedure is to identify the beta of each of the activities. Step 2 is to ungear the beta if it is geared. Step 3, you calculate market value of equity and debt of each activity. Step 4, you calculate weighted average asset beta, okay, or calculate asset beta of the combined. Then step 5, okay, you regear. Step 6, you calculate capital asset pricing model, cost of equity. Then step 7, you calculate WACCOCA. That's it.